Hey everyone, and welcome back. Have you ever felt that pit in your stomach when you see the market take a nosedive? That feeling of, oh no, what do I do now? Well, what if I told you there's a simple, almost automatic strategy that can help you look at those dips not as a crisis, but as a genuine opportunity? That's exactly what we're digging into today.
And believe it or not, this is class number 7 in our investment and wealth creation series. So far, we've been building a pretty powerful financial toolkit. And the tool we're adding today, it's one of the most important because it's built on two things you can actually control: your own discipline and consistency.
You know, it all comes back to this one question that just haunts every single investor. When is the absolute perfect time to buy? We all know the saying, right? Buy low, sell high. Easy to say, but how do you know if today's low is the actual bottom or just a quick stop on the way down?
To get to the bottom of that, here's what we're going to cover. First, we'll talk about why finding that perfect moment is so tricky. Then, we'll introduce a disciplined solution. We'll see it in action with a really clear example, explore the psychological benefits, which are huge, look at the potential risks, and then we'll wrap it all up with the bottom line.
Okay, so first up, let's really unpack the big challenge that this whole strategy is designed to solve, what we call the market timing problem.
Let's just be real for a second. Trying to perfectly time the market, it's pretty much impossible. I mean, even the pros, with all their fancy algorithms and teams of analysts, get it wrong all the time. For most of us, waiting for that perfect moment to jump in just means we end up sitting on the sidelines, watching potential opportunities just drift on by.
So if perfect timing is basically a myth, what's the alternative? Well, we shift our focus. We stop trying to be psychics and start being disciplined. And that brings us to our strategy of the day: dollar cost averaging.
So what is it? Honestly, it's super simple. Dollar cost averaging, or DCA for short, just means you invest a fixed amount of money on a regular schedule, like say $100 on the first of every month, no matter what the market is doing. The key here is fixed amount and regular schedule. It's all about being consistent, not about being a clairvoyant.
Now, the theory is great and all, but to really get why this is so powerful, we need to see it work. So let's walk through a practical example.
Okay, imagine you've got $500 that you want to invest. Instead of putting it all in at once, you're going to put $100 into the market each month for the next 5 months.
All right, let's follow the money here. In the first 2 months, the share price is $5, so your $100 gets you 20 shares each time. Simple enough. But look what happens in month 3. The price takes a dive, down to $2, and this is where the magic happens. Your same $100 now buys you a whopping 50 shares. As the price recovers, you buy fewer shares again. At the end, you've invested your $500 and you now own 135 shares. Your average cost? Just $3.70 per share.
Now let's hit rewind and look at the alternative. What if you had just thrown that entire $500 lump sum into the market back in month 1? You would have bought all your shares at that starting price of $5. And here it is, the side-by-side comparison. It's pretty stark, right? With dollar cost averaging, you ended up with 135 shares. With the lump sum investment, only 100. And more importantly, your average cost per share was way lower. DCA automatically took advantage of that price drop for you. No guesswork, no stress.
And hey, don't just take my word for it. This whole way of thinking comes straight from one of the greatest investors in history, Warren Buffett. He famously said he actually hoped his favorite stocks would go down so he could buy more. He doesn't see a market dip as a crisis. He sees it as a sale. DCA is a way to build that professional mindset right into your own plan.
Now, the math is obviously compelling, but the benefits of DCA go way beyond just the numbers. In fact, you could argue that the psychological edge it gives you is even more valuable.
You know, investing is just as much about managing your emotions as it is about managing your money. DCA helps with that big time. By making the process automatic, it takes your feelings out of the driver's seat. You're less tempted to chase some hot stock because of FOMO, and you're way less tempted to panic sell during a downturn. It just builds that discipline to stay in the game and be there for the eventual recovery.
It also helps you get around this weird mental trap we all fall into called anchoring bias. This is when we get obsessed with the first price we ever saw or paid for something. So if you buy a stock at 100 and it drops to 70, it feels terrible. But with DCA, you're also buying at 70, which creates a new, lower average price. It makes it so much easier to stick to your plan instead of feeling like you made one giant mistake.
Okay, but let's be fair. No strategy is a silver bullet. So for a balanced view, it's really important that we understand the potential downsides, the situations where DCA might not be the absolute best choice.
First of all, let's be clear, DCA does not guarantee you'll make a profit, and it won't protect you from losing money if the market is in a long, steady decline. And here's the main trade-off. In a market that just goes straight up without any major dips, well, a lump sum investment right at the beginning would actually perform better. That's because all of your money would have been in the market working for you for that entire ride up.
So, after looking at the good and the not so good, what's the bottom line? What should you really take away from all this?
At the end of the day, the right strategy always depends on your personal situation, your goals, and how you feel about risk. But for the vast majority of people who are investing regularly, maybe out of their paycheck, DCA is an incredibly powerful and practical tool. It builds the discipline you need for long-term success, and it systematically turns market volatility into your friend.
So I'll leave you with this question to chew on. In a world where none of us can predict the future, is having a disciplined process that you can actually stick to more valuable than constantly searching for that one single perfect moment? Thanks for tuning in.